Hello, welcome to the Friday edition of The Call here on ausbiz, Australia's only live streaming business and markets channel. Great to have your company for the next hour or so. As I say, this is The Call, 10 stocks suggested by you. I put them to an expert panel. We do it all from here at our Barangaroo studios, and great panel joining us today. One of my favourites. These two have always a lot to say, particularly in that small cap area, which it's so hard to get people of knowledge in that area. I am talking about Luke Winchester from Merewether Capital in Newcastle and Claude Walker from A Rich Life. And where are you? Are you from Canberra today, Claude?
Yeah, we are back in Canberra today, actually. We had to take the dog to the vet for his routine baby dog vaccination. So today in Canberra, back at the coast from this weekend.
I'm loving it. Luke, any vaccinations, animal or human, in your family at the moment?
Our little girl actually had her 4-year-old vaccinations last week, so there you go. Maybe that's the theme of the show today.
There you go.
No animals for us.
Is she at daycare? Kindergarten?
She is, and that's what I've loved about this COVID pandemic is we were catching worse stuff from her at daycare before it was all shut down. We've actually been a very healthy household since COVID started.
I know, they're like little petri dishes, aren't they? Daycare and kindergarten, blimey, and then it goes around the family. Hey, we've got a lot going on today. In the first half of the show, we'll be covering Veeam, DGL Group, Xero, that's an important one, Amero and DW8. So I thought I'd take a look at, for our stock of the day, to kick things off, at Whitehaven Coal. Came out this morning, cutting its full year production guidance 5% thanks to staff shortages due to COVID. Isn't every business going through that at the moment? And also weather-related uncertainties off the back of La Nina. Output in the second quarter took a hit, down 23%, though the outlook for metallurgical and thermal coal prices will be a tailwind and well supported over 2022. So what does the team think of this? Luke, you know, you're close to the Hunter. This is your backyard. What do you think of Whitehaven's update today, and also the share market's been smashed today?
Yeah, well, you know, Newcastle built on the back of coal. Whitehaven does a lot through the port here. It's a mixed bag of an update. Obviously, the production stuff is not great for Whitehaven, especially when you have elevated prices. It would be nice to maximise production and get the full, benefit of those higher prices. But look, it's not a surprise. You know, we saw the headlines of those Gunnedah floods a few weeks back, so not a surprise that the Upper Hunter there were sort of some production issues. And I think as investors, you can probably look past that a little bit. The big question becomes over coal prices moving forward. The business is pretty bullish on that outlook, partly because of restrictions in Indonesia, restricting global supply. And look, I mean, you know, this is a business I hadn't looked at it for a while, to be honest. And they mentioned in this update they expect to be net cash in this coming quarter, February, March. And I thought to myself, I was like, this is a business that had a lot of debt last time I looked. So I went back and had a look. And at the end of financial year 21, they had $800 million in net debt. So you're talking about wiping off nearly $1 billion in debt in a bit over sort of 8-9 months. You look at the market cap today, about $3 billion. Run those rough numbers. This is printing about 10% of its market cap every quarter at sort of the current coal prices and production levels. Now, you know, we know the space, and I think Claude will probably touch on it a bit more than I will around the ESG and the issues these guys face as you know, maybe a terminal decline of some of their customers they're supplying to. But look, you know, as value investors, if you're looking at a business like this, you're not talking about a long period of time where you could get a payback on your investment. Now, is management committed to returning that capital? I think so. Last time I checked, you know, they've committed to dividends and stuff. Maybe not as much as you'd like to see, given the cash that's being printed, but it's good to see they're obviously paying down that debt. Look, it's not for me. I don't have a huge ESG overlay to my investing, but I must admit coal is one thing I've never really looked at, and mining in general, I suppose. But but coal specifically. On those numbers, though, if you're the sort of investor that is willing to look past the ESG and can sort of have a bit of comfort around the coal price moving forward, I think you can step in and buy it today. But like I said, not for me, just for a certain type of investor that understands sort of what they're getting into.
Okay. Claude, you've got pretty strong ESG filters in your investment philosophy, don't you? So what do you think of Whitehaven Coal? And I understand, it's terminal, that energy sources are moving away from fossil fuels. That's going to take a long time, isn't it? And on the other side of it, there aren't going to be too many new coal mines built over the next 10 or 20 years. So dwindling supply, yes, it's on the way out, but gee, does it still have some value from an investment point of view now?
Yeah, so from an investment point of view, I think I probably agree with Luke. But it is still very important to think carefully about where the profits are going to come from if you do invest in Whitehaven Coal. Generally speaking, if we talk about buying a undervalued investment, the way we can make the money in two different ways. One is that the market realizes it's undervalued, says, oh, hey, let's not let this be undervalued anymore, bids it up, and then you can sell for a profit. And then the other way is that you just hold on to it super long term and get the dividends and the free cash flow coming back to you, or maybe the company itself buys back shares. That's sort of what we've seen with tobacco companies over the last decade or so. Essentially, the fact that they've had cheap shares because lots of people avoiding them for ethical reasons has allowed investors to make good money off them. I think Whitehaven Coal is, as close as you get to sort of a tobacco style situation there, where it's clearly trading at a discount to where another industrial company with the same level of earnings would trade, because it is a coal company. Yeah. But what you've also got to remember is that the chances of you getting a re-rate based on people deciding, hey, this is undervalued, we're going to bid it up, that is not particularly high. Like, that's possible, but over the long term, it's not super likely, because everybody knows it's undervalued. Everybody knows why it's undervalued. And this is when we have to start thinking about flows, right? Money is flowing away from this kind of activity because people around my age, around Luke's age, our generation have a drastically different approach to investing than past generations have. In the past, it's very socially acceptable to, make money in coal mining. Now, you have a minority who sort of think it's, very clever, and you have a majority of just the ordinary people who are like, no, I want to make money in a different way than that.
Yep.
And that is putting in place the settings for when millennials take political power to crush these kind of companies from a regulatory point of view. First, we get our money out of them, then we crush them. That is the plan. That is what millennials have to do, or our whole planet is going to burn. So step one is take your money out of these companies. Step two, once we get political power, we crush them with punitive taxes. We make them pay for the damage that they're doing that is currently a negative externality. The mine sites that are ruined, the farmers nearby that don't have access to water, and of course, the terrible emissions that are going to make the world unlivable for our children and grandchildren. So step one, take your money out. Step two, crush them. So I don't want to be holding it when the crush happens. So for that reason, I would avoid it.
Okay. Claude, can you be a bit more straightforward and not be so wishy-washy?
Well, I mean, I do agree. It's cheap on the numbers, right? So I think there's a possibility that you get paid by dividends. But what I would say is that the analysts have the earnings out at 30 cents per share, even in 2025, but the dividends only at 13 cents per share. So I would say this would be a real obvious buy if the company was committed to paying out all of their earnings, right? Because then they would pay you your money back really quickly. And I think maybe that's the end game for this kind of company, is actually do pay out all your earnings, but we're not there yet.
All right. Adam, our first stock that viewers want a view on. Adam wants a view on Veeam. Luke, you're our in-house expert on Veeam and have been for a year or two. Adam says, I purchased a small parcel of shares back end of 2021 as part of my speculative basket. It's since come back 20%, as is the volatile nature of microcaps. Interested in the long-term opportunity that this engineering company presents. It's got a marine propulsion and stability technology, doesn't it, Luke? I think the first time we came across it, you pointed me to a YouTube video on exactly what it did and became a lot clearer.
Yeah, they do the marine gyro stablers. Flick of a button and a boat can sort of stop rolling the tide. Look, Koshi, it's one. I actually sold this business, and I'll run through the timeline of what happened. And I still have it on my watch list, and I'm still liking it. And maybe to answer Adam's question, long term, there's reasons why I'm doing that, but. Just rewind. So this is one I used to own and previously said buy on the call and definitely like the stock. Now, back in mid-September, they undertook a capital raise, which is fine, and the founders also sold down to that raise, which I don't begrudge them. They own 60% of the stock, and they continue to own 50%. It's sort of what happened shortly after that.
It's a family, isn't it?
It's a family business. Yeah, Veeam is actually the initials of the founding family. And they then had their AGM update in mid-November, so only a couple of months later. And there was essentially a downgrade there. There were no hard financial numbers, but the language sort of indicated the business had seen some issues. And some of them, I suppose, were a bit forgivable. Like most WA-based businesses have had issues around skilled labour, and that's a theme you've seen consistent for a lot of WA-based sort of skilled trades. But then the other one was sort of talking about issues around conformities on the propellers and stuff that they produce. And talking about they've rectified them, but there'll be some sort of hit to the margins around that. And then also commentary that the gyro sales had been a bit lumpy over the past couple of months. And so you sort of bundle it all together. It was a pretty disappointing update. And you sort of wonder how much of that was known when they did the capital raise and the sell down. Now, I haven't completely written this stock off. Like I said, I still have it on my watch list. It's still one I would like to own.
But it sort of undermined your confidence, the way they did that.
It did, and I think more than anything, I don't think it's an untrustworthy management team, but I think they've learned a lesson in how to time these things with the market. Right. The optics were not good around the timing of it, and I think that they'll learn their lesson, and arguably they have. They put out another update in December, sort of saying they've seen conditions already start to pick up, and it looks okay. And so, look, from a long-term point of view, Adam, if you have sort of ridden it down to where it is now, sort of in that 90 cents range, I'd continue to hold it because I think the long term is still very strong. I think the gyros is a nice big addressable market that they're very early to. It goes back to sort of Claude's point on Whitehaven was a good one, that in the short term the flow of money dictates these things, and that happens in microcaps as well. They just have to get the market back on side, and arguably right. I'm a participant, a bit like that myself. I just need to see them come back and bring some trust and some faith back to the market. So on my watch list, if you're there, I would still hold it.
Okay. Rebuild the trust. Claude, view on Veeam?
So Luke did actually cover a lot of the points that I was going to make about this one. So I won't, repeat everything he just said, but I would add that when you have this situation that where the founders sell down, so they went from around 60% to around 50% of the company, right? So I think it's a pretty big sell down. It's their first big sell down since it was listed. They've timed that sell down pretty much when it was at the highest multiple, close to the highest share price it's ever been. And that has slotted that shares to like everyone who wanted them. Plus they've then gone and raised capital so that they've got even more cash. Now, this is a company that sort of supposedly can be profitable and doesn't actually need cash. So I don't know if it was sufficiently well explained why they need to actually raise more money then. These guys could have definitely, controlled this company by not raising money and paying out dividends, and then they would have got cash back to the family that way as well. So again, I don't really know if I buy the sell down as being anything other than the fact they were offered a good price for shares, right? But they say, it's about improving the liquidity, blah, blah, blah. I think it's going to be quite a long time before they overcome the overhang from those shares. Now, look, I will say on the good side of things is that they've pointed to the fact that with their, basically they've been moving up the scale to try and make higher profits. They want to make bigger gyro stabilizers for bigger boats where there's less competition or indeed no competition, right? So they've not only have they managed to succeed in doing that, they are proud to announce that they've also managed to have repeat orders from these customers for these larger gyros in USA, Netherlands, and Italy. So basically, what that points to is maybe this strategy of moving into the larger ones, which should be more profitable in the end, albeit more lumpy. Maybe this strategy is working. So that's why, for me, I definitely need to leave this one on my watch list. Definitely something that I would buy. But what happens is when you see one of these situations where the price gets high and the company issues a bunch of shares and sells down, what that means is you've got to be very careful when you're buying. Or for me, I have to be very careful that I'm definitely buying at a low price. So, currently I'll be waiting until the share price is lower before I buy, or I just won't buy it at all. And that's fine, because I'll always be scared that these guys won't let the share price run up heaps and hold on. They'll probably look to sell if it gets too high. So, that's not exactly what I'm looking for. But having said that, a decent investable company, one for the watch list, it's just too expensive for me right now.
Okay. All right. Luke, Catalina wants a view on DGL Group. By the look of it, it's a company that's in the sort of dangerous materials, chemicals area, the transport, storage of it, warehousing.
Yeah, it's a pretty recent float, only sort of mid last year, and not one I'd actually looked at too closely, but ticks a lot of boxes. I mean, they're in that sort of chemical, around the whole life cycle of chemicals, basically, from the manufacture of chemicals to the storage and logistics, all the way through to disposal, recycling. And if you read their presentations, they seem to have done a very good job of having a network nationally around the country. And it seems that it's a bit like a Cleanaway or a Bingo, where having strategic locations, in the right places is a moat in and of itself for a business like this. So having the scale and the locations. So there's a lot to like. The founder still owns 60% of the business. And unlike Veeam, which we just spoke about, it's actually a good little dichotomy here. He was on market buying an extra sort of 500,000 shares in sort of mid to late December. So a lot of confidence there. It's not cheap, about 17 to 18 times sort of EBITDA, which I don't actually love EBITDA as a metric for a business like this because it is a little bit capital intensive. But nonetheless, let's go with that for a second, because if I compare that to a Cleanaway, who I think's a sort of a peer you could look at, it doesn't look crazy. I have noticed they've been very acquisitive since listing. May last year, and they've already made 6 acquisitions, where normally my red flag indicators go up when I see something like that, where a business is so acquisitive. I would actually hesitate to say it's probably not as big of a red flag for a business like this when you have a 60% founder still in the business. Yep. That sort of thing worries me if it's a CEO who doesn't have those sorts of ties to the, it's not a business that he wants to see around for sort of 50 years or the rest of his life. Whereas this founder, I'm sure, would really be thinking through the strategy and the long-term vision of this business every time he makes an acquisition. And it does seem that way when you read them. So, look, like I said, I've only looked at it getting this list, so I don't know enough to say buy to Catalina, but I'll definitely hold. I don't think the valuation's super crazy. The business looks really strong. You've got that founder there. There's enough there for me to definitely say hold to someone if they're already in it.
Okay. Claude?
Yeah, so actually DGL Group is one that I own a few shares in myself. It's not a large holding because basically, as Luke says, it's very expensive. I would just plain use earnings for this one as a way of valuing it. And based on the current forecast for FY 2022, it's probably on about 73 times earnings, which is just way too high. But what you're looking for here is, that was a FY 21, and it's still 45 times on my forecast or the consensus forecast of FY 2022, right? Which is really still quite expensive for what it is. But what we're looking for here is a situation where by rolling up these different specialty chemical businesses, the company is able to get operating leverage. And because this is an asset heavy business with a distribution network of all things, it is quite likely that we will see some of that operating leverage come through which means that profits can grow faster than revenue. So that means even though it's on arguably 43 times profit for FY 2022, that should come down in future years as they execute against the strategy. And then the secondary point, which is actually, if I'm honest, part of the reason that I sort of perhaps somewhat opportunistically bought in, and I'm still holding, even though this hasn't really been a massive winner for me, is that DGL Group's Australia's largest producer of AdBlue, which the press was reporting has actually like quadrupled in price in some areas in mid-December last year. So basically, at the moment, there are even accusations of price gouging and that kind of thing. Essentially, it sounds like these guys are the supplier of something that's in short supply, and that is potentially a profit. It's potentially a marker that there's going to be slightly higher profit than expected. When you combine that with the high insider ownership and even insider buying, it makes me think that the business has good momentum. Perhaps it's going to come in ahead of expectations a little bit in the short term, which should mean it shouldn't be too bumpy. And then if the roll-up strategy can actually work, you have a longer-term thesis where it can grow into its valuation.
So you Luke, hold rather than buy at these levels?
For me, it is actually it's like a sort of speculative buy. It probably is going to go down if interest rates keep going up. We're in a rocky market for these kind of growth stocks at the moment. So, I just dip the toe in the water, right? But because I think this is a fairly good quality business, it's one that I'd be willing to build up if the share price does come down, as long as they're executing and staying above where they said they'd be.
Perfect. All right, Luke, Will wants a view on Xero, the small business accounting software platform. Will says quality company, capital light, scalable, with a global presence. Since the start of the year, the share price is down 35%. Is it time to buy the stock under $120? This was a market darling for so long, but as Will was saying, has taken a bit of a thumping, hasn't it?
It's definitely a quality business, and Will's highlighting all the reasons why. It's that capital light. You've got a huge addressable market globally that they're genuinely entering into. I think it is probably one of, if not the highest quality business on the ASX. The issue was always valuation. You were paying sort of 20 times recurring revenue, which was expensive no matter how you wanted to sort of overlay the growth on top of that. It's had that pullback. I went back and had a look. I was on the call back in early December, and I said hold. The price has fallen since then, about sort of 15-20%. But one of the things I was highlighting back then, and the business hasn't updated since then, so it still is accurate, is I just need to see more US traction with this business. And one of the things I highlighted was revenue growth in the US was below their user growth, meaning they're struggling to pass on sort of price increases, and if anything, it signals sort of price decreases, and that's likely to do with the competition they have over there with Intuit, which is the established player in the US market. Been a big jump in expenses in FY21. Now that either needs to normalise now, or they really need to show the growth on the back of it. The market, I think, has forgiven them for that jump in expenses, but if you're going to do that, you need to see the benefits flow through. So they'll be reporting soon. I still think it's a hold if you're there, Will. You said it's below 120. Is it time to buy? Claude's touched on it. We're just not in the sort of macro environment where you want to be stepping in confidently to a stock like this. Now, what can quickly change that is a good fundamental result. So I would just hold it. If you're on the sidelines and you're watching the price pull back, I don't think you have to jump in. Wait for that result. Wait and see what the numbers are and reassess from there.
Yep. Claude?
So this is another one so I own a little bit of Xero shares. I actually think it's one of my smallest holdings. And the reason I own it is because Xero is, in my view, top 3 quality businesses on the ASX. So when I see a business that's such high quality, I kind of tend to always want to just have a little bit in my portfolio because they're the business I watch closely and want to make sure I bought it. I bought this in March 2020 when there was a big sell-off, because for me, I want to buy those quality long-term businesses when they're cheap. However, what is cheap for Xero? Well, I would argue that at this point in its evolution, where it's really quite dominant in Australia and New Zealand, and it's got plenty of room to grow in the UK, and it's almost struggling to grow in the US. it's still fairly expensive. Based on the last half, it was operating revenue of about $500 million. So if we just sort of very roughly, and albeit a little conservatively, because it will grow, say it's making about $1 billion a year. Well, it's its market cap I'm talking in revenue, and it's going to be like about break even. Its market cap is about 17.5 times that. So it's still kind of expensive there, but I would not expect to see Xero trading at much below 10 to 12 times revenue, even in a big sell-off. So certainly if it came down another 25% from here, we're talking maybe under $100. That's when I'd think, all else being equal, that's when I'd start to buy again. So for now, it's just a little bit too expensive to me. Okay. Other than that, I agree with Luke's comments on it. But for me, it's going to be still a hold, and then below 100 is probably when I get interested.
Okay. Shibneet wants a view on Amero. Shibneet says, recommended at higher prices. Like to get thoughts on it. Is it still a buy with a significant pullback from 55 cents not that long ago? They're sort of 3D manufacturers, aren't they? But in parts specialising in aviation and the space sector. Claude, what's your view on Amero?
Yeah, so my view hasn't changed in the last year. So actually, I was on this show with you, David, and Rudy about a year ago on December 11, 2020. So a little more than a year ago, and the stock was at 57 cents then. And Rudy said he wouldn't touch it with a barge pole, and I more or less agreed. At the time, I pointed out that they had in the last quarter made receipts from customer of just $72,000, right? Well, fast forward a year, and in the most recent quarter, they made receipts from customers of $111,000. So we're still talking like, less than that, less than, a knowledge worker's annual salary per quarter. This is really not much of a business yet, in my view. They recently announced they had heads of agreements with Gilmore Space Technologies, which sounds very exciting, which is a 3-year term and expected to deliver revenues of 1.7 million total revenue. So that will be, again, less than $1 million. Even if this comes through, it's less than $1 million revenue per year. Meanwhile, based on the last quarter, they had $3.5 million quarterly cash burn and $8 million cash. So the way I see it is these guys don't really have, their main business is raising money from the share market, and that's still their main business for the foreseeable future. So they're going to get out there and they're going to sell lots of stuff they're doing, about exciting things, about how good they are and everything. But the main game for them is just get money off investors who believing in the dream. Yep, good point. I don't believe in the dream until I see some solid evidence.
Yeah, Luke, have you got a dream as in regards to Amero?
Not quite, Koshi. And I sort of noted that point when Shivneet said it was recommended at higher levels. I don't know who recommended it, but certainly I straight away thought to myself it wouldn't have been Claude or I. Look, I remember these guys listed. I rewind maybe 2 or 3 years ago. 3D printing was a mini boom on the ASX, and that happens every now and then. We had cannabis, we had lithium the first time, we had crypto back then. And you get these little pockets where the market gets excited. A few companies who are early stage in that market list. Most of them, wind up going to nothing, which Amero looks like it's going that way, but let's wait and see. A couple sometimes make it, and it all sort of flushes itself out. Having a look at them, it looks like they're still doing a bit of that 3D stuff, but it looks like they're trying to pivot to just the supply of titanium powder for other manufacturers. That could have some legs. That's a real product, and I'm sure there's a market there for that. It's about getting to that, and the capital needed to do it. As Claude pointed out, I was about to say client list. You can't really call them clients. It's all memorandum of understandings and heads of agreements. But some of those names are impressive: Boeing, Raytheon, Rio Tinto. I agree with Claude. My main takeaway was there's more raises here. The revenues are tiny. In the next 6 months, there'll be a raise. That's not my sort of stock. I don't mind a bit of speculation, but I always try to come in when I think that last capital raise is out of the way. The spectre of a capital raise is no longer overhanging the stock, and a business can sort of self-fund itself moving forward. So not for me.
All right, look, Adam wants a view on DW8. This is sort of like an investment fund, isn't it, into businesses, digital or technology businesses in the beverage market. They own a stake in Wine Depot.
Yeah. I think I'd heard of this stock, like the ticker before, but I never really looked at it. And when I read the description, it sounded interesting. Wine Depot is a cloud-based tech platform to connect stakeholders in the wine industry and focuses on like a marketplace solution, inventory management, logistics, payments. That's interesting, and I'm sure there is a software, like that across, or if there's not, there's a good sort of market fit for that. What got me though when I looked at the stock was the numbers don't match the narrative in a sense. Like if you have a look at this business, they do gross margins of 3.5%. Like that's, you'd expect that from a fixed price mining services contractor or something like that, or they probably do more, to be honest. And that actually, that was FY20. It actually fell to 35 basis points in FY21, despite 400% revenue growth. I had only looked at this business, yesterday and this morning, so I may be missing something, but to me, that's not a cloud-based business. A cloud-based business, as Claude, would be well aware, software businesses should be 80, 85, 90% gross margin. That's the real thing you look for with a cloud-based tech business, is the scalability over a common platform. I don't see it here. There's growth, but the growth is coming through the burning of a lot of cash and a lot of capital, and I think there'll be another raise soon. So not for me. Look, maybe if you knew a bit more about the product, you could hold it, but unless you have that, it's probably just a sell and a move on.
Okay. Claude, DW8, is it for you?
Oh, no, certainly not. But I think Luke did a great job, but he maybe missed a fefew things, but they all just make the picture look even uglier, if you ask me.
Okay.
First of all, I agree with what he said. And second of all, on top of that, some of this growth has been through acquisitions, right? It's not that they have a product that's so compelling that people are, flocking. Maybe it is compelling, but that's not driving the growth. The growth is being done by acquisitions, which has taken advantage of, the ability to raise capital at what I would argue is a very generous, valuation. Now, but I think we've got to look at that chart. We all saw that massive ramp, right? What was going on there is this was a Reddit meme stock. Okay, this was extremely heavily promoted on ASX bets and also on a lot of the very, very promotional Facebook pages that I monitor, and it also has had like tons and tons of coverage on a website that I won't talk about, but other than to comment that website discloses at the end of all of its articles there may be a conflict of interest present with commercial arrangements with companies and or stock held. I couldn't tell if the company actually has a commercial arrangement with Digital Wine Ventures. I couldn't see where it said that or not, but it might be there. So what I think here is we see the picture of, a stock that has been very heavily hyped, and now it's sort of gradually coming down. And, in a sense, if you want to understand what's going on with stock, one of the mistakes I sometimes make is to apply my fundamental analysis to a instrument of speculation that is actually got nothing to do with the fundamentals of the companies. That's why, for some of these companies that are now $2 billion, I was saying, hey, it's got no revenue. It was undervalued at $1 billion. Well, it was overvalued at $1 billion. What's happening is it doesn't matter what the company's worth because the stock is being treated as a speculative asset.
Yeah.
And it's just short term. It's a voting machine. The market's a voting machine. Only long term will it weigh. And now if you look at the voting machine, if you look at Reddit posts from a year ago, they're all like, oh, DW8, wow, just wow, it's amazing. They love it. Now the Reddit posts that are getting the upvotes things along the lines with, DW8 going live on eBay now, have a drink, help a bag holder, and it's just even more amusing ones that I won't say. So I think that the worm has turned there.
All right, just got rorted. All right, let's recap our first 5 stocks and the stock of the day. Whitehaven Coal, after its update today, neither Luke or Claude like it on ESG filters and also the future for coal. Veeam, a hold from Luke, a no from Claude, but has it on his watch list. DGL, maybe a speculative buy from Claude, a hold from Luke, Xero a hold from Luke, a no from Claude. If it got below $100, then he'd start to be interested. Amero no, and DWA to no. In this half hour, our next 5 stocks include Tissue Repair, Kogan, Zeotech, FOS Capital, and TZ Limited. All right, Jeffrey wants a view, Luke, on Tissue Repair. He says this company has just done its IPO, got hammered. It's about to start a phase 3 trial and is almost cash backed. This, of course, is a biopharmaceutical company in the tissue repair, chronic wound, cosmetic procedure, aftercare market. As Jeffrey's saying, only recently listed.
Yeah, in that wound care space, and we have a few on the ASX, which it's good to see. I suppose we have these businesses. Maybe sometimes they don't all provide massive investment returns, but they're businesses we hope succeed in what they're doing with the product. The float, look, I can't comment too much on the float other than the price suggests it was either handled poorly or the timing maybe didn't work. It quickly got there's the chart there.
Yeah, wow.
$1.15 was the issue price, and you're talking like 2 months later, it's more than halved. Something has gone wrong. I can't comment on what that is. I don't actually know. Jeff's correct in the sense it's close to cash backing. It's about a 30 mil market cap, and they raised, with proceeds from the IPO, they've got about 27 mil in the bank. They will start eating into that cash though, Jeff. Admittedly, cash burn up until this point, I went and had a look at the prospectus, has been pretty, conservative. I think last year it's only about $800,000 they burnt. I expect that will really ramp up as they come into the phase 3 trials and look to bring this product to viability and to the market. So don't invest in a business like this just because of that cash backing, because I suspect it will come down sharply. For me, you have to have some sort of insight into the science here, which I just don't have. If I look at this financially, peers like Polynovo, I can't, top of my head, I can't remember the others, but there's probably 2 or 3. Aroa Biosurgery, there's a couple of those wound cares. They already have products in the market selling. It's easier for me to look at them. Like, they may be expensive, but there's numbers I can value. Something like this is just too speculative unless you had a really strong view on the science behind it, which I don't have. So for me, it's an avoid. But look, like I said, if you're willing to do a bit of that work, it's something that could be interesting just from a market dynamic on how far it's been sold down. Okay.
Claude?
So I won't add heaps to that because Luke has pretty much nailed it. I'd say that I'd add to this that people should not anchor to the IPO price, right? The IPO price is what they managed to find a group of buyers that would be willing to pay when they were sold a story. The price that it trades at on the market is the price that you get when there are buyers and sellers, creating an equilibrium. So, the IPO price is gone now. Like, forget about that. This is the price that it's at. And basically, it's had really unlucky timing. Like, if you look at the biotech index in general, it's down massively, I think almost 50% over the last year, and then another 25-30% in the last few months. So there's going to be an element of just really tough timing here. And then in terms of the actual product, look, they themselves in their materials say, these kind of, it's like a wound gel to help close chronic wounds. I'm sure it could help some people, and that would be great, but there hasn't been very many new products in this category approved over like a long period of time, which maybe means that it's hard to do. And they also may not have yet enough money to actually get it all the way through to commercialization. So that means there might be more dilution along the way. So it's too risky for me. Okay.
Claude, Olivia wants a view on the online retailer Kogan. During the week, share price hit a 12-month low on Wednesday. It's down 35% in the last 6 months. Up today, when the market's being smashed, a rebound from that 12-month low. What do you think of Kogan?
Kogan's never been a really favourite business of mine. I basically think that perhaps management's paid a little bit too generously, and basically I don't think that their offering is that good. And I think on a long enough scale, like, these guys have to compete much more with Amazon and also other companies that are also in that e-commerce space. Like, there's no rule that says Kogan can't face new competition. So long term, I sort of feel like actually the era we're in right now, they're having maximum advantage for being a first mover, and that is going to go away very slowly over the next decade. Secondly, what we're seeing in the last year or even longer is basically just like the massive come down from the fact that these guys had a perfect moment in time. Yeah. When the pandemic first impacted society, we had to go and buy like almost everything online, and a lot of the other retailers were not so well set up for online commerce. Kogan was already perfectly set up. They didn't really have to change anything. They were ready to rock and roll. So they had a massive advantage. On top of that, everybody had so much more money because of JobKeeper, JobSeeker, and all that kind of stuff. Nobody was hard up. Everybody was actually buying stuff, TVs, etc., to make their house nicer because they were going to be spending a lot of time there for the next year or whatever. So they had a really perfect moment in time, and the share price just got completely crazy and out of control. And in my opinion, there's going to be a really long period, like perhaps they'll never get back to those highs, No. And so for me, this is generally, I am kind of bearish on retailers at the moment. Increasing interest rates is not going to be great for the consumer spending. Facing the pandemic now without JobKeeper and without JobSeeker, that's not going to be good for the consumer spending. And also, there's the argument that the pandemic just brought forward a lot of those purchases. Sure. So overall, I'm bearish most retail, but including Kogan.
Okay. Luke, it's interesting from what Claude was saying. You look at that 5-year graph and it's back down to the level just immediately prior to being hit by the pandemic and that March crash in 2020. So it's certainly retraced a lot. What do you think of it at the moment?
Yeah, that's a chart. You can find a lot of those charts of COVID winners that have just done the round trip back to where they were pre-COVID as everything normalises. Claude did a really good job of covering the macro things around Kogan and I guess consumer discretionary in general. I'll probably pile on a little bit with just the numbers around Kogan, which, this was a business that had inventory issues caused by some of those things that Claude outlined around they stocked up and then demand didn't quite come through like they expected, forced a little bit of discounting and took a hit to the margins. The last couple of updates they've given to the market, they've sort of suggested, or the commentary has suggested they think they're through those issues and the business, is set to recover. But you haven't seen in the numbers yet. And even their last update at the AGM was through to the end of October. Prior to that, they gave a quarterly update through to the end of September. So, you're able to get a snapshot of what October looked like as a standalone month by subtracting the AGM update from the quarterly update. And October continues to be impacted despite, management sort of hinting they thought they were through those issues, a few months ago. So, as an example, in October, gross margins were still flat. EBITDA margins continue to fall from 3.5% to 1.5%. So until I actually see the recovery come through in the numbers, I can't really step in and buy. Like, I know when you see a chart like that, as Claude sort of pointed out with tissue repair and the IPO, it's only natural to try to anchor yourself to where the price has been, but you can't do that. You have to focus on where the business is now and where it's going now, and the numbers don't support the share price moving higher. If you've written it down and you sort of have researched the stock and believe where it can go over the next few years, you can probably hold, but in the current environment, given the macro and given the weakness in the actual numbers, I'll probably say sell. Okay, all right.
Luke Stewart wants a view on Zeotech. Now, this is a mining-based technology, isn't it? I can't quite understand what it actually does. They talk about producing sponge-like structures, and it's for the gas and petrochemical industries. But they're working with the University of Queensland, so it's a new technology.
Yeah, I was hoping you could shed a bit of light there for me, Koshi, because I was much the same. I had never heard of this business, and I saw the chart first, and my first thought was, I bet this is something to do with like lithium green tech or something like that, and I was right once I dug into it. So as best as I can tell, and again, I caveat this that I only sort of looked at this business for the first time yesterday. These guys, their technology is around synthetic zeolite, which obviously Zeotech is where the name of the company comes from, and that can be produced through kaolin or as a byproduct of lithium. So, you're arguably taking a byproduct of a processing of lithium. With that synthetic product, you're right, it has sponge-like characteristics, and it reminded me a bit like Calix, who developed, some technology around
that carbon capture,
carbon capture technology.
Yeah.
But you can take your core IP and try and move it to all different sorts of verticals and solutions.
Yep.
It looks like these guys are trying to do the same. They've got this core IP around, the zeolites and their sponge-like capabilities, and they think they can be used in a range of different processes. Now, look, whether they can or not, wait and see. It's too speculative for me. You get a bit of comfort from their partnerships with universities. Most, tech or research that comes out of universities is usually genuine. Whether it can be commercialized is another question, but the tech's usually interesting and there's usually something there. So that gives you a bit of comfort. It's still so early on in the process. One thing I don't mind, though, is they're looking to move up their supply chain or down their supply chain. I'm not sure the right term there, but they're actually, buying a kaolin mine to feed into the production of the zeolites. So that, makes a bit of sense. A lot of buzzwords was one of my main takeaways. Like I said, it's too speculative for me. If you're willing to do some work around the tech and get some comfort about what it is and what it can do, I'm sure there's some big addressable markets there if it works. So, maybe a speculative hold for people who've done that work, but otherwise you're probably just punting on an idea.
Yeah. Claude?
Yeah, I think, look, this is definitely, in my view, punting on an idea. These zeolites, they're catalysts, they're molecular sieves, they're all these things, but they're also still supplied, from what I can tell, by, people in China as well. So it's not like these guys are going to have some, exclusive thing that, as I understand it, like there's going to be alternatives to these guys. It's not like they've got something that people are, dying for. At the same time, they have... they sort of seem to be everywhere in terms of like what they're aiming for. Lithium refinery, clean tech, carbon capture and utilization, carbon markets, nutrient management, mycotoxin absorbance. That's in agriculture. They've got all of these potential uses for their product, which they don't really have yet, and they don't have any meaningful revenues, no receipts from customers at all in the last quarter. And here on my notes, I've got it saying a $2.5 million cash burn last quarter, but only like around $6 million cash. So I guess they're going to run out of money soon as well. Oh, I think it might have been per year. Sorry, that cash burn. But the point is that, look, it seems super, super risky. And it seems to be that the main reason that you buy shares is that you're hoping that the narrative will take over and the share price will go up because, it's ESG or because it's got something to do with lithium or whatever. But, that's just such a punt.
All right. Claude, let's go from zeolites to traditional lights. Malcolm wants a view on FOS Capital. They design, engineer and manufacture commercial, retail and industrial lighting.
Yes, that's right. So this is a really simple business that you can understand much more easily. So they are, a company that makes, but also orders in. So they'll resell, but they make some of their own lighting for industrial and large scale, like maybe street lighting or huge buildings, that kind of thing. They can either order in, but there's also certain lines that they make themselves, they manufacture themselves, then they distribute that in Australia and New Zealand. And what I have, this is kind of interesting because this is a tiny microcap, and I'm going to mention, I actually own a few shares in this as just sort of a wait and see approach. Now, basically where they are at the moment is they're still burning cash, like in terms of their historical results, they're still burning cash and they're not really making a profit yet. However, since they have, the whole point of them listing is that they were able to then raise some capital so then they could actually buy other companies and roll up and get a little bit more scale. Right. And right now, they are forecasting a huge increase in revenue going forward. Now, based on their FY21 results, excluding IPO costs, they would sort of break even or very mildly positive profit, right? So that implies that if they can just, through acquisition, get a little bit more scale, but keep the costs under control, then their profit could pop up quite considerably. And in that scenario, this tiny little company, which I think is about $13 million market cap or something, could suddenly, start making $2 or $3 million profit, and then it'd be on like 5 times earnings. Now that's the upside. Of course, this is again such a tiny little company. If for whatever reasons costs blow out, maybe they have supply chain issues, whatever it is, it can go the other way, and suddenly my little profitable company that's supposed to be really cheap is actually it's blowing up because it's not making a profit anymore. Right. That's the risk you run with these tiny businesses. So I think that the risk reward is good. So I like it.
Okay.
Yeah, I mean, but it's just, you've got to keep in mind it's speculative. The way you really make money out of these is if you own it and then it actually gets bigger and safer, and the downside risk reduces at the same time as you're already making money because it's become quite profitable, can probably even, fund more growth then, and it sort of snowballs. That's what I'm hoping for.
All right. Lou?
This was one I'd never looked at closely before, despite being a micro cap and the sort of business that I like to own. As Claude said, it's pretty boring. It's just a lighting contractor. And when I looked at it, Koshi, I think you've got the only 2 panelists today that would put this stock in the portfolio. I think most would just say it's too small and not look at it, but you've got the micro cap guys on. So I agree with Claude. I think it's speculative, and look, an institution can't come and buy this stock today. Like, if you were to pay up to 25 cents where they IPO, there's about 20 grand worth of stock to buy. So, but for individuals at home and they're, got a small portfolio and are willing to speculate a little, and when we say speculate, we're not talking about like tissue repair or Zeotech before. Right. The speculation, as Claude outlined, just comes from the size of the business. But everything else looks good. I mean, insiders own 65% of the business, 10 mil market cap, 5 mil cash. A chunk of that's from the IPO, of course. Slightly profitable FY21, but I agree with Claude. If FY22, they're looking for revenue to nearly double, and if those margins hold, which you'd expect them to hold and maybe even grow a little bit given the scale you'd get over that sort of revenue growth, it's a business that can easily do sort of 2 to 3 mil profit relatively quickly.
Right.
Okay. Sorry, if not FY22, maybe FY23. So I say speculative buy as well. Spec buy, plenty of small acquisitions. Claude outlined it. Put in the portfolio.
Okay. All right, excellent. And our final stock, we're running a bit at a time. Luke Sol wants a view on TZ Limited. Extremely thinly traded, has a few major clients, has some tailwinds behind in Sol's opinion. It is a software company for, by the look of it, controlling sort of logistics and business expenses.
Yeah, so I'll keep it brief, Sol, but this is a business on my watch list. I don't own it, but it's a business that could be interesting if they can execute over the next couple of years. So very quickly, these guys do smart lockers. So, they'll sell a bunch of smart lockers to an enterprise client, and then they have some software behind that which allows them to be open remotely, controlled remotely, or access pass to different people. There's a bit of smarts behind the scenes, obviously, in the smart lockers themselves. So the business was selling those lockers. New management's come in and is looking to take the software behind the lockers and distribute that externally. So open up their software to other brands of smart lockers or companies that have their own sort of suite of lockers, but they don't have those smarts yet. If they can execute that, it looks really interesting. For last quarterly was cash flow positive. Bear in mind, they still will be lumpy as long as they're still selling the actual lockers themselves. That is a sort of lumpy sort of cash flow nature. On my watch list, it's a micro cap that well and truly could be a bigger business if they execute. So, look, if you're actually there already, I'd continue to hold it. But for anyone else, just keep an eye on this one because if they can do what they want to do, it turns itself into an interesting little business.
Claude, what do you think?
Look, I agree with everything that Luke just said. But I will sort of add that these guys are, in my view, still in like a desperate risk stage. So like they recently did a capital raising to cover the remaining debt and general working capital. So basically like the fact that a loss-making company has debt at all is just way too risky for me. The fact that they sort of have to do these desperation capital raises to cover that is also a red flag for me. And then the final point is these guys have actually been listed quite a long time. They have $16 million revenue, and they still don't make a profit. So for me, it's been too long of good promises but no delivery. So now I'd be a bit harsh and I'd want to see that profit.
Okay. Claude Walker from A Rich Life, have a great weekend. Appreciate your time.
Thank you for having me.
Likewise, Luke Winchester from Merewether Capital, always good to catch up.
Thanks, Koshy.
Good on you guys. They're terrific, aren't they, as a pairing? One of my favourites. Recap the final 5 stocks. Tissue Repair, a no from both. A no from both on Kogan. Same with Zeotech. FOS Capital, speculative buy from both of them. Really interesting, that one. Tiny business, microcap, but they like what they see. And TZ Limited is on Luke's watch list. A hold from him, a no from Claude. That's it for our show for today. If you've got any stocks you want to flick through to us, do it via email. The call at ausbiz.com.au or tweet us using the @AusbizTV handle. If you want to see all the stocks in the calls portfolio, head to ausbiz.co/portfolio. 1st of February, we've got some big announcements on the calls fantasy portfolio, so I can't tell you too much, but you will really love it. Quick programming note for you, be sure to join us later this afternoon. Or Explore Chief Executive Brett Giroux joins us after 3 p.m. to take us through the company's debut on the stock exchange. Have a great afternoon. A lot still to come here on Ausbiz. Don't go away.
Currency play here. What are you expecting? Is it a euro trade?
For me, it's using a wider trailing stock. We're trying to capture those big